Hello, listeners. My name is Raj Singhal, and welcome to another episode of Breaking Investment Stereotypes. This episode is brought to you by Multipie.co, where we believe that investing is an ignored life skill. Our mission is to create a platform where people can come, learn, share, and collaborate through the right tools. Ultimately, we want your hard earned money to work for you. Here at Breaking Investment Stereotypes, my job is to deconstruct world class investors or wealth managers and deep dive into their investing journey professionally, personally, or both, to get into how they've broken the stereotypes in a seemingly complex world of investing. I want to give little guidance on how to use the shows. None of the following should be taken as an investment advice. Please see multipie.co/disclosures for more information. My guest for today is Gautam Baid, who is a CFA and author of the international bestseller, a book called The Joys of Compounding, and portfolio manager at an SEC registered investment advisor based in Salt Lake City, Utah. Previously, he served at the Mumbai, London, and Hong Kong offices of Citigroup and Deutsche Bank as a senior analyst in their healthcare investment banking teams. Gautam is a CFA chart holder and a member of CFA Institute. And in 2018 and 19, he was profiled in Morningstar's Learn from the Master series. So without further ado, please listen to my conversation with Gautam. Hey Gautam, welcome to the show. First of all, thanks a lot for doing this at this time. I know you live on the other side of the world, and I hope that you all are staying safe as well in these tough times. Let me start with your life, Gautam. How did a boy from Kolkata become a fund manager in the US and an author of the prominent modern investment classic, The Joy of Compounding? Over to you, Gautam.
So I was born and brought up in a Marwadi family in Calcutta. I'm the youngest of the 4 siblings in my family. As you know, among all us Marwadi community in India, we have entrepreneurship and business in our genes. So ever since my early teenage years, I was very fascinated by the world of business, especially by the idea that once the strong foundation is established for a business, the owners do not work for money. Rather, money works for them. I did my graduation in commerce with a specialization in accountancy. So pursuing higher studies in the field of finance seemed like a natural extension. So I did my MS in finance from ICFA University, Hyderabad, and I did my MBA in finance from Nirma University, Ahmedabad. And I also went on to obtain my CFA charter from CFA Institute, US. After my MBA program got completed, I got a campus placement with Citibank as an analyst in their investment banking team in Mumbai, where I worked for 3 years. And from there, I joined Deutsche Bank as an analyst, senior analyst in their investment banking team, where I worked at their Mumbai, London, and Hong Kong offices for almost 4 years. As regards with regards to my beginnings in the stock market, as is typically the starting story of many investors, I got pulled into the stock market out of sheer greed during the final euphoric phases of a bull market. In my case, it was the 2003 to 2007 bull market in India. I still remember 2007 and a very fancied stock named Ispat Steel in January 2008, as both of them were in the hot and fancied sectors of power and steel at the time, and both had recently appreciated sharply in a very short span of time when I first noticed them. So I just engaged in blind extrapolation of the recent price trends in them without paying any attention whatsoever to their valuations. Now, recency and vividness biases are very powerful but highly costly behavioral mistakes. Both those investments crashed 70 to 80% within 12 to 18 months of my purchase, and I had successfully gained admission into the stock markets by paying my tuition fees. Despite this bad initial experience, my curiosity and interest about the stock markets always remained very high throughout the initial 7 years of my professional investment banking career. And one fine day, I came to the realization that we just have this one life to live our dream. And I did not want to waste any further time doing something that I was not really passionate about. I was earning good money as an investment banking analyst, but I was not really deriving that internal happiness and satisfaction, job satisfaction. And I was so keen for a career shift that I relocated to the US in May 2015 without any job in hand. So one of my relatives who is an American citizen, he sponsored my green card. I was under the impression that I will land a stock market job within a short period of time since I was a CFA charter holder And this particular degree is generally considered to be highly valued in the investment management industry, in particular in the stock market. But as you know, life is not a bed of roses for those trying to carve their own destiny. I got rejected in my first 3 stock market job interviews in the first 6 months in US, but I did not give up. I was very firm and very adamant that I'm not going to go back to my previous field of work where the presence of perverse incentives constantly led to incentive cost bias and conflicts of interests and did not suit my personal nature. So I kept declining all investment banking job interview calls that came my way in the US, even though they would have had very high dollar salaries. At the same time, I ran out of whatever little money I had brought with me from India. And to take care of my living expenses in US, I did not want to sell even a single share from my portfolio of Indian stocks, as I did not want to interrupt the process of compounding. And we were undergoing a big bull market in small caps and mid caps at that time. So I took up a minimum wage job as a front desk clerk at a hotel in San Francisco, California, where I used to work during the graveyard shift. For the uninitiated, this is the shift that runs from 11 p.m. at night to 7 a.m. in the morning. And I worked there for 15 months. Now, even though it was a big struggle for me physically, emotionally, culturally, and intellectually, today in hindsight, I highly value those days of my life because for the first time since the beginning of my busy professional career, I finally got some free time for myself to read and learn. And this was the phase during which my learning curve really took off from a small base. Little did I realize at the time that I was laying down the strong building foundation for compounding in my life. The pace of work during late night to early morning at the hotel was pretty slow, and I made full use of the downtime and the free time I had to read every single article published on blogs like Safal Niveshak, Fundu Professor, Jana WordPress, Basic Investing, and Microcap Club, among others. And the passionate pursuit of lifelong learning had finally begun. Now, luck, chance, serendipity, and randomness have always played a big role in various aspects of my life till date. One fine night during November 2016, while working at the hotel, I just randomly clicked on the quick apply button on a job application on LinkedIn during the course of my routine online job search. And wonder of wonders, I unexpectedly received an interview call for the job, and that too for a senior role in an investment firm, even though I had zero formal work experience in the stock market. And this was the phase in my life during which I was about to experience the power of compounding knowledge in action. All those hundreds of hours which I'd spent during the previous 15 months at the hotel reading the blog articles had built a strong intellectual foundation for me in investing. This is what I was lacking during my first 3 stock market job interviews in US. And this time I excelled in all the 3 rounds of my job interview because you see, body language derives from self-confidence, and self-confidence in turn derives from knowledge. I was offered the role of portfolio manager, and it was like a dream come true for me. And never in my wildest dreams did I expect to land the profile of a portfolio manager. I thought I'll join as a junior analyst since I did not have any previous prior stock market experience. And then I'll work my way from there over 10, 15 years to become a portfolio manager. But I was instantly inducted as a portfolio manager, and life has been great since in this particular work. Today, even after achieving financial freedom, I continue to work in my job because I just love the work that I get to do. And the icing on the cake is that I get paid for getting to learn and improve every day. Now, that was about how I became, a portfolio manager. As regards to a brief history or brief background about the book. So, in
Yeah.
early 2018, I self-published the initial edition of the book, and I made the book available to everyone at zero profit and did not charge any fee or royalty to cover the costs of production, marketing, and distribution, or to compensate for the hundreds of hours of personal effort. Because what had happened was during the bull market in India from December 2013 to December 2017, in the small caps and mid caps, I had basically achieved financial independence during that particular phase, and I wanted to give back to the community. And there was a bigger mission and a higher purpose in my mind to spread the message of the virtues of lifelong learning and helping others unconditionally. And subsequently, after the success of the initial self-published edition, I signed publishing agreements with Columbia Business School Publishing and HarperCollins India for uh, the Indian subcontinent region and the rest of the world regions, respectively. So that is a brief history of how the book has come into being.
Hey, thanks, Gautam. I think that's very inspiring story. And I actually read or heard somewhere that you actually applied for about 1,300 buy-side roles, before landing into this particular one. Well, why don't you tell our listeners more about that?
Here, I would like to devote a few minutes to discuss the sheer power of passion and being passionate about something in life. So, like I said, I spent 15 months working as a front desk clerk at the hotel in San Francisco. And I still remember during every night, I used to apply to a minimum of 3 stock market jobs online. So if you simply do the math over a period of those 15 months, I'd applied to more than 1,300 stock market jobs. Now, Raj, whenever we take out the time to fill up the job application, attach a resume, and click on the submit button, there is always so much hope attached behind every single submission. To face rejections more than 1,300 times and still keep on going is only and only possible. And I can vouch for this. It is only and only possible if you're truly passionate about what you want to do in life. If you're absolutely razor sharp focused, if you're absolutely fanatic about what you want to do, if you're absolutely sincerely dedicated to what you want to do in life, that then only you can keep on going. That is, why I keep tell people that resilience is a superpower. So basically, that is how. And after those 1,300 rejections on the 1301 application, I finally landed in my dream job profile. So the key to compounding is just to keep going, keep going. The key is consistency. Dogged incremental progress over a long period of time is the key to success, and that is what compounding is all about. You just need to keep on going because you never know when you're going to make it big, when you're going to hit the jackpot. So just many of there's so many people in the world who have just given up, just when they were within a sliver of tasting success, but never give up.
Yeah.
Because compounding will test your patience and convictions to the fullest before bestowing its rewards upon you.
Yeah, I completely agree. I mean, and frankly, that's why they say, right, investing is also more about human psychology, human behavior. Not just about knowing what exactly the investing is. And then we will come to all of that. You touched upon. I love that you touched upon one life to live a dream and passion. I think those are the key elements, and that will keep people driving, applying for 1,300 jobs and waiting for that. You just need a one job, right? You just need a one job, but you don't know when that is going to come, right? So you have to keep trying for that. So you explained that your book talks about compounding. Can you share experience of how compounding has worked for you in investing and in any area other than investing, right? You mentioned that the book is not just about investing. I mean, the same principles can be applied to life as well. So let's pick on compounding, such a great eighth wonder of the world. A lot of people talk about it, but for people who are listening to us, how do they should think about compounding?
So you basically asked about sharing any experience of how compounding has worked for me in
Mm-hmm.
any area other than investing. In investing, obviously we know the power of rule of 72, about how our money basically doubles every 3 years, compounding at 26%, grows 10 times in 10 years, compounding at 26%, and 100 times in over 20 years, compounding at 26%. Along the way, we achieve financial independence. So that is basically how compounding works for everyone in the investing world. But if you ask how compounding has really worked for me in any area other than investing, so one key area is in the area of compounding goodwill. So in my book, I've talked about how we should always endeavor to constantly add value to others in our relationships on our own initiative without expecting anything in return. So let me share a story from my book. In September 2017, a senior investor with whom I had previously spoken a couple of times alerted me to some scuttlebutt finding at his end about one of my portfolio companies being unable to pay its factory workers, and that it would default on the upcoming interest payment on its debt. This turned out to be a timely warning because just a few days later, news broke in the media that this company was trying to defraud its lenders by artificially inflating its asset size on its books of accounts to get bigger loans from the banks. The stock promptly declined by almost 30% in the next few days. Thanks to my senior's timely warning, I was able to exit the stock a few days earlier at a handsome profit. And when I called my senior to thank him and I asked him why he had helped me by sharing such sensitive information, these were his words. because you always used to share helpful company and industry data with me from time to time, even when I never asked you for it. You helped me then, I helped you now. These were his words. And Raj, I believe this positive feedback loop always exists when you engage in the smallest of good acts for others. The acts tend to take a whole circle and return to bless you with positive things in your life. Karma is like a big snowball. Ask yourself at the end of each day, did I do at least one good act to help someone today? After that, thank the Almighty and your parents in your prayers for all that they have given you in life. I personally do this ritual every day, and it gives me great inner peace. And I guess that is why Michael Jackson's song Heal the World has resonated so strongly with me ever since I heard it many years ago.
No, awesome. I mean, I think, and I have also seen that in my life. Whenever you do something for somebody in a very selfless manner, I mean, it definitely, it will come back to you. They will give back to you in some way, or even if it doesn't give back to you, the joy you feel in giving to someone, I think that is tremendous. And in most of the time, I've seen that, definitely, it gives back itself. So I think, I mean, we've been dealing and talking, bits pieces here and there, and most of the stuff is actually pointing towards human psychology. Human psychology matters a lot in day-to-day life, but a lot more in the investing as well. And I think you covered that in your book. Some of the stuff like overrated versus underrated behaviors. Like, for example, I sincerely believe that intelligence is overrated. So do you want to bring in some of the points around human psychology elements specifically related to investing?
Sure, I can bring across some of those overrated and underrated behaviors as well. So I still remember many of them as far as investing world is concerned. So knowledge is overrated, wisdom is underrated, intellect is overrated, temperament is underrated, outcome is overrated, process is underrated, short-term outperformance is overrated, long-term adherence to one's investment philosophy is underrated, the gross return is overrated, stress-adjusted return is underrated, upside potential is overrated, downside protection is underrated, maximization of return is overrated, avoidance of ruin is underrated, growth is overrated, longevity is underrated, entry multiple is overrated, exit multiple is underrated, price to earnings ratio is overrated, duration of competitive advantage period is underrated, categorization of stocks into large cap, mid cap, and small cap is overrated, and categorization of businesses into great, good, and gruesome is underrated. Being more frequently right than others is overrated. Being less wrong than others is underrated. Forecasting is overrated. Preparation is underrated. Confidence is overrated. Humility is underrated. Conviction is overrated. Pragmatism is underrated. Complexity is overrated. Simplicity is underrated. Having a high income level is overrated. Inculcating a disciplined saving habit is underrated. Competition with peers is overrated. Helping them is underrated. Large personal net worth is overrated. Good karma is underrated. Talent is overrated. Resilience and durability are underrated. Being the best investor is overrated. Being the most authentic version of yourself is underrated. So these are many of the overrated and underrated behaviors which I've talked about in my book. And this is the outcome of the last 14 years of investing in the market. This is the summary of all the big learnings.
No, this is really awesome. I mean, I was just listening to that, and then you actually brought in very important points. And one of the thing I actually recently wrote about is life is all about being curious and learning. And any time of the life spending on trying to prove yourself right is actually a waste of life, right? I mean, there's no point trying to prove yourself, right? Just keep learning. A lot of gems here, in a matter of couple of minutes in terms of what is overrated, and a lot of those actually, not I would say all of them have resonated with me. If you want to talk about some of the stuff, I mean, the human psychology part, more tuned towards investing, and how do people look at, right? I mean, the people say that greed and fear are the two biggest enemy of investing, and both of them are related to the human psychology, right? I mean, when markets are going down, when markets are down 30%, one should be actually buying, but a lot of people actually end up selling or doing nothing. So do you want to spend some time on elaborating some of them?
Oh, sure. So I think, so in my book, I've talked about how, human beings are a messy living compilation of a multitude of behavioral biases especially when it comes to matters related to money. And that is what the stock market is all about. So some of the key psychological biases to which investors generally fall prey, and I'll just speak about myself here. So I've in the past made multiple mistakes of commission because I fell prey to bias from over influence of authority, listening to a renowned so-called market expert on television and just blindly following his recommendation. And then I lost money on his recommendation. Then bias from anchoring. So just, many people don't understand that a stock that has fallen 99% is one which has first fallen 90% and then fallen another 90% from there. So basically one should separate price from value. Just always focus on the intrinsic long-term value of the business instead of focusing on the stock price. Stock price is available to everyone and known to everyone. The value is not known to everyone, and how to assess value, that ability is not with everyone. So that is where you can actually you know uh, exploit other people's you know lack of delayed gratification, because people tend to sell stocks for all sorts of reasons which is not related to long term intrinsic value, but because of any short term negative or short term problematic issue. So just by practicing time arbitrage, you can gain an advantage over the other people. Then another key behavioral bias is bias from liking and disliking tendency. Here again, one should always separate the personality of the promoter of the company from the economics of the underlying business. Just don't get developed, just don't get emotionally attached to the founder or the promoter. Always focus on the quantitative parameters and the qualitative parameters of the underlying business. Then a few other psychological biases of note are cognitive dissonance, and the foundational bias, for which lies at the heart of most behavioral biases, is loss aversion. Basically, many people, many investors tend to hold on to losing stocks in the hope of breaking even and then moving on to the other stock, instead of understanding that the loss does not need to be recouped from the same stock on which the loss has been incurred. If you just if you have a stock in which you are sitting on a loss with no hope or no expectation for improvement, simply book your losses and move on to the next opportunity. The market provides an endless stream of opportunities on a regular basis, so there's no dearth of opportunities. If you have made a mistake, just acknowledge it and just sell it and move on to the next good opportunity and make up your losses that way. You don't have to just remain stuck in a melting ice cube or a sinking ship. So those are some of the important psychological biases which investors should be aware of.
Yeah. So I want to bring in 2 points here, and then this is also one of the question which was asked to us very recently. And then one point is that people say timing in the market is super important than time. Time in the market is more important than timing the market, right? And another question which was recently brought to us is that people struggle to decide when to sell. And then we always see that you speak to people, friends and families, they will tell you what to buy, but nobody will tell you when to sell. This whole timing the market, when to sell versus time in the market, what's your thought on that?
Let me tackle the selling decision. So this is very, very important. So there are some key reasons for when you should make a sale. Number one, obviously, is when the stock which you're owning has reached absolutely absurd valuation, factoring in the next 15-20 years of high growth ahead. Suppose a stock which you own has been re-rated by the market to 150 to 200 p, and if the growth is also slowing down, then that is one good reason to sell the stock because of absurd valuation. Second reason is when management starts displaying some capital misallocation, or if there is a corporate governance issue in the company, then that is a good reason to sell. And the third reason, which is very, very common, is if you have simply found a far superior investment opportunity to invest in. So those are the three important cases where you can actually exit a stock and move on to a better opportunity. As regards the debate of time in the market versus timing the market, it is my personal firm belief that it is time in the market and not timing the market that drives wealth creation. If I had gotten scared and exited the market during the periodic phases in 2013, 2015, 2016, 18, 19, and 20, when my portfolio value fell 30 to 35%, with many individual stocks down 40-50%, then I would have completely missed out on all the big bull market years in between, which helped me achieve financial independence early in life. So it is very, very important to just remain steadfast in the market and let compounding work its magic. Let me quote a study done by Sage One Investment Advisors. They mentioned that even though the market index in India, the Sensex, went up 251 times between 1979 and 2017, so massive wealth creation, if you had missed 7% of the best months or 1% of the best days, your returns would have been zero. So
Wow.
this itself shows, the importance of not trying to time the market. And let me also share a small quote from my book on this topic, that investors need to bear the periodic bouts of downside volatility as the price to be paid for earning superior returns from equities. Time in the market matters, not timing the market. The ability to keep investing at regular intervals, to stay the course through thick and thin, ups and downs, and bull markets and bear markets, and to not worry where the markets are going tomorrow or next week or next month is what matters.
Yeah, and there are enough examples of very high quality stocks, including like say Amazon, where the stock has fallen 20%, 30% multiple times, right? I mean, and that could have, but look at it. I mean, somebody has just held the stock all this while, the kind of phenomenal returns. The another company which I keep reading, and I drew on that, is Netflix, where I think once the price fell by about 60 to 70%, right? But the amount of amazing returns which those stocks have generated over the years, if you held them for 10, whatever, 10, 15 years, is incredible. So uh, I think enough studies prove this, that time in the market is super important, the timing in the market. And for that, I think the one key element you need as an investor is to hold yourself, when the markets are falling, right? I mean, usually people make a mistake when markets are falling. Let
So
me
here,
move. Sorry, go on, Gaurav.
Raj, if you don't mind, I would like to
Yeah,
add a
sure, sure.
very good example here to your examples,
Mm-hmm.
which I've shared in my book as well. So, very high quality stock called Fairfax Financial fell 80% between 1999 and 2002. How many investors do you think would have had the nerves to hold on to a 80% decline over 4 year period? Very, very few, right?
Yep.
Now here I would like to share a very big learning from my last 14 years, that how does one develop the ability to hold on to a high quality business which is falling in a stock price? It is through diversification. Be sufficiently diversified, because if you are having a 2-3 stock portfolio in which one stock falls 80%, you'll be really suffering a lot. So the key here is, if you want to develop the tenacity, the most natural way to develop the resilience or tenacity to hold on to quality businesses which are falling in stock prices, to have a diversified portfolio. Trust me, this works, because what will happen is, even if one stock is with a reasonable or low weight is falling in price, there will be many other stocks from different sectors which will be going up, and your overall portfolio will be doing pretty decent and well. This is why being diversified is so important.
No, and completely. I think that's the first principle of investing, right? Diversification is the first principle of investing, and unless and until you have the guts and the stomach to take kind of risk which some people do take. So let's bring in you've been investor for a very long period of time. You've been writing, and you meet up and you speak to a lot of people. What is do you want to bring in any investing mistake that you made, and what that taught you?
Yes, let me just, in terms of quantum, the biggest, until date, the biggest loss in absolute terms has been from a stock called Bandhan Bank. So I'll just, share, what psychological bias I fell prey to. So a few years ago, I had read a book by Tamal Bandyopadhyay titled Bandhan, The Making of a Bank, which talked about Chandrasekhar Ghosh, the founder of Bandhan Bank. And after reading his story of struggle and I found it very inspirational, and I developed an emotional attachment with him. So, and a few, and in early 2019, I believe, when Bandhan Bank was facing collection issues in its microfinance business in Assam, and the stock price was literally crashing, I still held on to it, just because I just had this liking bias for the founder in my head, and I just got emotionally attached and involved. That's why I could not get myself to sell the stock, even though I was sitting at a heavy loss. And even though there was clear disconfirming evidence in front of my eyes, I still did not act on it. So that is what led to the learning, which I've shared in my book, that always separate the personality of the promoter or the background of the promoter from the business economics of the underlying company always. That was the single biggest learning that I had, that never get emotionally attached to stocks or or the founder or the promoters, because that will lead to suboptimal decisions and behavioral biases. Always act objectively and rationally. The key to stock market success and to success in life in general is being rational in your behavior. That is what, and this is an ongoing journey. We'll as we keep on learning, we'll keep getting more and more rational over time.
No, I think that's a great, and I think you touched upon this earlier as well about don't get emotionally attached to to the founders, and you may have a like or dislike. Look at the business and take a, as they say, right, look at data more than anything else, right? If the data is telling you something, just don't ignore it. uh
That's why the famous saying, right? The stock does
yeah,
not know that you own it.
yeah, the stock does not you on it. Yeah, yeah. Let's change gear and come back what you on a personal level as well. You write a lot. You have a lot of followers on Twitter and LinkedIn, and you write very regularly. What are the good practices you've inculcated? Like journaling thoughts. How do you you read a lot? I'm sure you read a lot. And how do you make sure people call it a second brain? What's your idea of a second brain?
Very good question on the journaling. So I spent $10 on a journal in late 2014, and I consider it to be one of the best value investments I've ever made. Since that day, I've been keeping track of my investing decisions and the subsequent developments in a journal. And this habit has helped me a lot in learning about myself and improving both as an investor and an individual. I receive a lot of valuable feedback and I use it to correct my biases. You see, the process of structuring our thoughts into a journal entry brings clarity into our thinking, and journaling by hand reduces the possibility of hindsight bias. It is hard to look at your own writing and deny your previous thoughts, right? So, a periodic review is an important part of the process. This is how you start getting better, realizing where you make mistakes, why you make them, and what the common mistakes are that you tend to make. All can help you improve over time. Whenever the outcome of a past decision is known, revisit your decision journal, and odds are you will discover some surprises. In many of the favorable outcomes, you'll commonly find that the original reasoning wasn't right. Outcomes distort our thinking a lot. And unless you're humble and intellectually honest, you will end up taking the wrong lessons from favorable outcomes. It is not intuitive to honestly recall how the events unfolded, especially after getting a favorable result. And we may be right a lot of the time, but it may well be for the wrong reasons. This self realization can be humbling. It is also how we learn and improve. So, always maintain a journal. This will help you remain true to yourself and keep learning in your investing journey.
So what maybe do you want to expand a little bit on the how do you actually do that? Do you write every day, or how do you make sure there are various things you need to write about? One is of course your own investment decision. One the things you read. Do you want to elaborate a little bit more for somebody to somebody who's not done it or doesn't do it and how to do it?
It's actually very, very simple. So every day nowadays we have all these WhatsApp groups, Telegram channels, all these business channels and various other media, social media. So we are always bombarded with various recommendations and promising ideas, right? So if you come across any particular stock recommendation which which you've studied on a particular day, simply write down. If you decide not to buy it, for example, just write down in a journal that this is the stock which I studied today, and this is the thesis why I did not invest in it. It can be as simple as the stock being outside your circle of competence, or it can be because of some concerns which you may have. Just note it down. Whatever is going in, just in simple bullet points, just write it down why you did not buy a stock. And if you buy a stock, conversely, if you buy a stock, just write down your basic thesis in 3-4 bullet points about why you think this stock should do well in the future. And very importantly, when you when you buy a stock and write down your thesis in the journal, also conduct a pre-mortem. Pre-mortem is nothing but simply assuming that, let's assume 1 year has passed and the market has been steady, it has not fallen much, but the stock which you have bought has fallen sharply. What could be the reasons for which the stock has fallen sharply after 1 year? Even though you bought the stock, you should always still conduct a pre-mortem and write down the potential downside, because this will force your mind to think in terms of downside risks. You'll start, and that will also help you with individual position sizing. this is an art. This is where the art part of investing comes into play. Basically, the higher the risk with an individual stock, the lower the allocation should be, and the more the higher the risk reward ratio, the higher the allocation should be. So this is where maintaining a journal is so effective. Until basically the most important thing is that you'll keep this is how over time you will start developing pattern recognition, because you will know what works and what didn't, right? So it's in front of you. So this is and investing is all about pattern recognition. It's about nothing else.
No, I think that's a great thought. I mean, I'm trying to I've been trying to journal my thoughts as well, and I've been using multiple ways to using a simple doc to using now Roam, and in between I tried Notion as well, but I'm still struggling how to get everything together. I hope to achieve that sooner. Uh, can you name one book, one of your favorite book, and what is that book, the other book which you're reading currently?
So currently I'm actually reading and reviewing an advanced copy of a upcoming investing book. It's by a fund manager in Sweden. He's sent me an advanced copy from there, and I'm reading it currently. I cannot disclose the name and the author name right now because it's confidential, but it's the book basically what he has done is he has collected a list of or compiled a list of 114 investing related questions and answered them uh, in the book. And so far it has been a very engaging read. I'm pretty sure it will be a very big success when it comes out later this year. After I'm done reviewing and reading this particular book, then I'll be reading How to Decide by Annie Duke, the author of Thinking in Bets. And it's basically a book on how to make better decisions. And as you know, as investors, our basic job is to make decisions. That's what we are paid for. So it's always good to keep on learning about improving our decision making. So it's pretty interesting reading list. Looking forward to it.
And yep. And what's your all-time favorite book so far?
Well, that's
tough one, but yeah, if you need to name one.
Well, it would have to be. It's a personal choice, but it would be Getting There. It's by an author named Gillian Joe Siegel, in which she has basically written very inspirational stories about many successful people, about their humble beginnings and how they overcame many adversities in life to reach where they have reached. And aside of this, three books basically come to mind straight away. Aside of this, which I'll share just for the benefit of the listeners. One is Seeking Wisdom by Peter Bevelin, the finest book on multidisciplinary thinking which I've come across. Then there's a second book by the same author called All I Want to Know Is Where I'm Going to Die, So I'll Never Go There. It basically talks about the theme of the finest book written on the theme of inversion, or what you want to avoid in life. And the third would be Poor Charlie's Almanac. That's again a great book for investors and non-investors alike, and for all lifelong learners. It's written by Pete Kaufman of Glen Eyre, and is summarized and edited all of Charlie Munger's past speeches in that book. It's a wonderful piece of work.
Yeah, so it is actually really wonderful. I recently bought that, and I'm in the middle of that. I will surely look up to the other two recommendations which you made. And for our listeners, don't worry, we'll put all of this recommendations in the show notes as well. If you want to pick up, I'll ask your. So one is, who's your life idol, and second is, who's your investment ideal?
Well, in life, my idols are my parents, to be honest, and I've dedicated an entire section in my book to both of them, the chapter on role models, because ultimately, most of us are simply a function of our upbringing, and our parents play the key role during our upbringing, and the most of the values which we exhibit throughout life are inculcated from our parents. So those would be my life idols. And from as an investing idol, I would name my mentor Utpal Seth, with whom I had connected 7 years ago on LinkedIn. We have been in touch ever since. He's the CEO of Rare Enterprises in India, which is Rakesh Jhunjhunwala's asset management firm. Utpal Seth is responsible for investment management, risk management, and institutionalization. And why I consider him my investing mentor is because he enlightened me on the concept of value creation. So for many years, I used to think that all growth is good, but that is not the case. Companies which have, returns on invested capital less than the cost of capital, less than their cost of capital, for them growth is value destructive. It's actually this. This is the key principle of value creation, that growing firms with high returns on invested capital, opportunities for reinvestment internally at those high returns on invested capital, and longer competitive advantage periods are very valuable in terms of net present value. This is the holy grail of long-term value investing. You want to look for companies which have excess returns on invested capital over cost of capital for long periods of time because of competitive advantages, which is known in the investing parlance as moats. Examples of moats are strong brands with share of mind, which confer pricing power, a company having network effects, or a company having high switching costs, a company having a collection of patents, or having favorable access to a strategic raw material resource or proprietary technology, or enjoying government regulation which prevents easy entry. These can confer a strong competitive advantage that in turn enables excess returns on invested capital over the cost of capital, which is basically nothing but the free cash flow yield. ROIC minus cost of capital gives you the free cash flow which the firm generates. And since buying a stock is nothing but having a part ownership in a business, this is what you want to focus on: how much cash the business generates and how much of that cash can it put to work again at that high rate of return. That is what gives you the compounding machines, as we call them.
No, awesome. And so you mentioned that you connected to Utpal Seth through LinkedIn. Is that correct? I mean, that's how you guys got connected.
Yes, so he was liking what I was posting. So one fine day he just messaged me and saying that he likes what I post and to keep up the good work. That is when we started developing a rapport after that.
That's incredible. That's incredible. And it should be definitely inspirational for a lot of listeners who are really want to, uh, this is the one way you can get the mindset or mind space of people whom you are targeting to. Just keep writing on. You have so much access to through the social media. People are reading good stuff. So if you're writing, somebody will take a note of it. So just keep writing. I think
Here I would
that's a
like
good.
to here I would like to add some more important insight that Naval Ravikant of AngelList, he has very famously quoted, "Learn to sell, learn to build. If you can do these two, you'll be unstoppable." Why does he
Yeah.
say that? Because many people in the world know how to build, Raj. They know how to build
Yeah.
good stuff. They know how to they have good content. But many people, many of us, especially in India, have this preconceived notion that they feel embarrassed to promote themselves or
Yeah.
sell their skills on social media. Why? There is an audience out there waiting to be served. They want help. If you don't learn to promote yourself, to sell yourself, to sell your skills, make yourself known, how will the audience come to know about you? How will you attract like-minded people into your fold? You have to not have this hesitation to just exhibit your skills on social media or television or through a blog or on a YouTube channel. This is very, very important. You have to know both. It's not just enough to learn how to build. You have to also learn how to sell. Both are important.
Yeah, and I love Naval Ravikant, and he keeps putting a lot of stuff. Since we are on the social media topic, I want to ask you, who are the apart from guys like Naval and some of the names you mentioned, who are the top handles you would strongly recommend anybody to follow who's interested in this whole investing world?
Well, let me just try to recall them off the top of my mind right now. So one is obviously
So
Morgan
couple,
Housel, who's a fantastic. Yeah, so go on.
so sorry, I'd say a couple of names you mentioned earlier, and I want to bring them up again for the benefit of the listeners. One was a Safal Niveshak, one is a Fundu professor, the third is a micro cap club. So these are a couple of the names you mentioned. Did I got them right?
Yes, I'll just repeat them. So what you reminded me? So Safal Niveshak, Fundu professor, which is Professor Sanjay Bakshi, Jana WordPress, which is Jana, and the Basic Investing that is run by John Huber of Saber Capital Management, and Macro Cap Club is run by Ian Castle. Ian Castle is a great handle to follow for the investing public. Along with that, I would also add Morgan Housel of Collaborative Fund. He writes very, very good blog articles on investing.
And he wrote a great book, The
He wrote
Psychology
a
of Money.
fantastic book. Yes, I really
Yeah,
enjoyed reading it.
yeah, one of my favorite
and
book
and
as well.
and it's very I think here again I'll add that it's very important to always curate your Twitter follower list, basically whom you are following, because ultimately social media is nothing but it's an amplifier. It's an it leads to an echo chamber,
Yeah,
and you want to have basically diversity of thoughts, and you want to have diversity of opinions. So very important to have a nice mix, not just just not follow people following a one particular philosophy. Just have access to diversity of opinions. That's very important to keep
yeah,
an open mind.
and absolutely correct. And one what I have done at my end, because initially when you get onto stuff like Twitter, you actually end up following a lot of people. But what I've done is I've created a couple of lists, and that's a great feature of Twitter. If people are not aware, you can curate your own list, add the people who are your top accounts to follow, so that and then you can and you can read just tweets from them itself rather than looking at your overall feed. So that is what I do, and I found it very useful. So I've made a couple of them for my top accounts, and then there are other interests I have, like crypto, and there are other interests I have. So I think it's a great feature of the Twitter to curate your list.
I
Uh,
think Twitter is a great place to find very relevant information in a timely manner if you use it in a constructive manner. I think many people unfortunately use it for trolling or engaging in other negative activities. But I think personally, for lifelong learners and people with a learning mindset, it is the one of the greatest resources. Just keep on
yep.
accelerate your learning curve. It's like a university on a wide variety of topics. One of the best universities on the internet.
And it's free. We're coming to the end of our very lovely conversation. So I have a last thing for you. And this is in two parts. One is, what advice will you give to your 20-year-old self? And where do we see Gautam in next 10 years? So first,
Well,
what advice you will give to your 20-year-old? Suppose you're 20-year-old now, and where will you be next 10 years?
so there are a few very important, important investing lessons which I wish I knew at the beginning of my investing career. I'll share a few of those very important lessons. Number one, learn to distinguish between investment and speculation. A speculator looks at a stock as a piece of paper. An investor looks at a stock as part ownership in a business. Number two, Mr. Market is always eager to hand you great opportunities from time to time on a platter, because stock prices fluctuate far more than the intrinsic value of the underlying business, sometimes wildly on either side. And therein lies the big opportunity. Number three, and this is very important, be an ardent student of crowd psychology, cognitive biases, market history, and human behavior, since objectivity, rationality, and temperament are far more critical than raw intellect to succeed as an investor. Your personal behavior matters much more than advanced Excel skills and complex math. Always think quantitatively, numbers and probabilities, and not dramatically in terms of vivid images or futuristic stories. Fourth important lesson is develop a working knowledge of accounting, as it is the language of business through which you understand how the balance sheet, income statement, and cash flow statement tie together. Lesson number five, always focus intensely on the underlying process, then obsessing about the eventual outcome. Resist the illusion of control. Lesson number six, always consider the outside view, which takes base rates and statistics into account rather than only the inside view, which makes predictions based on a narrow set of inputs. Less important lesson number seven. This is very important. The frequency of correctness does not matter. It is the magnitude of correctness that matters. And Michael Mauboussin calls this the Babe Ruth effect. It is, as per like the famous saying goes, it is not whether you're right or wrong. It's about how much money you make when you're right and how much money you lose when you're wrong. In the stock market, there are only four possible outcomes: a big win, basically a big gain, a small gain, a big loss, or a small loss. As long as you can avoid the big losses and keep your losses small, you'll be absolutely fine. So don't focus on the number of stocks on which you make or lose money. Focus on overall portfolio returns and overall portfolio CAGR. That is what is important. Lastly, point number 8, lastly and most importantly, for any investment decision and for all important decisions in life, always take the potential consequences into account instead of focusing only on the raw probabilities. So these are basically the 8 important lessons which I would give my 20-year-old if I was starting out as a beginner investor. As
Real
regards your
gems.
next question,
Yeah, real
yeah,
gems. Yeah, thanks. Yeah.
we get to learn a lot over time.
Yeah.
And as regards your my long-term vision for myself, I think I do see myself probably engaging in a in my personal philanthropic efforts on a much more larger scale. As of now, it's pretty limited because I don't get to devote much time. I'm in a full-time job here, but I think in the future I would like to devote much more time to my philanthropic efforts, because I think with compounding over the next 10 years, the personal wealth will become pretty substantial. That is when I would like to devote more time to family and philanthropy. And on the professional front, I do see myself doing something on the investment side in India, and helping the public and many investors and many individuals and working professionals you know, uh, earn a lot of wealth. For that, before that, I need to register myself with SEBI, so I'll be working on that. So yeah, if there's any announcement on that front, I'll share the same with all my followers and friends and colleagues on social media. Hopefully, hopefully in the foreseeable future. So let's
We'll
hope for the
look
best.
forward to that. We'll look forward to that. And you said that you're doing little on the philanthropy. I would say that you've actually done a lot. The amount of knowledge you have shared with people over the years, including what you've written in a book. I mean, and I think there is no better philanthropy than that. What you've learned over your lives, and you're trying to put it in a book, and giving out to people. I think there is no better giving back than that. And we will look forward to you doing more for back home in India. Thanks a lot for that.
Sure.
Yeah. Yeah, thanks a lot, Gautam. I mean, I really enjoyed our conversation. Hope to have a round two of this some point in time in coming months or year. I really enjoyed the conversation. So thanks a lot for doing this.
Thanks a lot, Raj. It has been a pleasure. Thank you.
Thank you. Thanks a lot, everyone.